Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We're counting down to the next VRIC, January 21st and 22nd, 2024. As soon as tickets become available, you will be able to find out here. But of course, we're keeping the channel going with great guests for you every week. And today, we are joined by Lobo Tiggre from the Independent Speculator, someone I always enjoy talking to, and a great speaker who was at the VRIC last year, and I'm hoping will be there again in 2024. Lobo, it's great to see you.
Well, that's if they invite me back. I have a reputation for raining on the parade, so we'll see.
Well, I'm going to make sure you get an invite. I will insist. And I wanted to start off today's interview with some breaking news. You know, if you follow FinTwit, everything's breaking news. But in this case, it does seem somewhat significant, and that is the regional banking sector. Many of the stocks seeming to be in free fall, with trading halted, including PacWest, Western Alliance, Metropolitan Bank, and others dropped considerably at market open. Well, gold has risen back up past $2,000. So what's your take on this situation? Is this proof that there is systemic risk in the banking sector, that the Fed is starting to break things, and why is gold up?
Well, there's several different ways we can go from here, but your final question is actually somewhat different from the first one. But let's start with a couple things. One is the banking question itself. I'm not a banking expert, and I'm not just going to dodge the question, but I want to put that out there. The stops, the Fed and the FDIC, the powers that be pulled in order to try to quell the banking panic were huge. I mean, the Fed, it was basically an all bailouts for everybody to honor bonds at par, right, that were underwater. And never mind making the depositors at SVB whole or whatever. I mean, that action for everybody, that was huge. This was an enormous, everybody's talking about, oh, it's not a crisis. It's not a crisis. But that was a crisis level response. Now, okay, maybe they nipped it in the bud. That's what, the hope was. And honestly, until today, it kind of seemed like it did. Even with First Republic shutting down, and over the weekend it gets foreclosed. JP Morgan steps in, gets a sweetheart deal, right? The talk just yesterday, markets were open yesterday, Monday. It's Tuesday as we record. Markets are open, and Mr. Market seemed to be thinking, oh, it's okay. The powers that be kiss the boo-boo, everything's fine, right? Suddenly we wake up today, maybe not so much. The takeaways are, I think, one, that all banks in a fractional reserve banking system rely on confidence. They're all con games. Even the most solvent banks, I can think of only one that even claims to have all the money actually in the bank to honor all deposits. Nobody tries to keep all deposits money there. You lend and take in funds, and that's the banking business. So basically, they are all vulnerable to a confidence shock. So I'm not trying to scare anybody here. I'm just putting it out there as a basic cornerstone to remember. And bringing my gold bug hat real quick, this is a reason why we own bullion. It's not because we think the gold price is going to go up or whatever. It's because it is bullion. It is something with intrinsic value. You can hold it in your hand. You can be long with zero counterparty risk. There is nobody short to the gold ounce in my desk drawer here. Now, it's only a silver ounce, burglars. There's no gold in my desk drawer here. So keep that in mind. Now, going back to my first statement, I'm not a banking expert. I honestly can't tell you that I know what's going to happen next, Jesse. By the time this goes live, maybe things will have boiled down or boiled over. And maybe that's worth stressing for a moment, too. Was Doug Casey's due diligence guy. He sent me around for a decade and a half, kicking rocks to proof stories for him and customers of his International Speculator. Now I do that as the Independent Speculator for my clients. This doesn't make me a banking expert. People ask me where the economy is going to go, where interest rates are going to go. And I try to give my best answer, but I'm not a guru. I don't pretend to predict the future. I'm a due diligence guy, doing my best, and just like you or I or the audience out there. That having been said, all these caveats there, whether this boils over or simmers down, that's not the end of systemic risk. It's the one thing that I did say most stridently as a result of the banking panic since March was that even if the powers that be do tamp this down, that doesn't mean it's the end of systemic risk. And I think there was a sense out there in the mainstream that, oh, this is it. The Fed broke something. We all knew the Fed was going to break something. It broke something and everything is okay. It's not so bad. Well, maybe it is not quite so good as people thought. But even if they do smooth it over, that's not the end. I mean, the record rate of interest rate increases. And people say, oh, well, Volcker raised them higher. Well, sure, but from a higher base. From 0 to 5% is a much bigger leap than from 15 to 20%. And the impact it has on the economy, I think, is still working its way through. It's the pig going through the python. There's a lot of python in the US economy for that pig to go through. And it's not just the monetary policy, but the fiscal policy. We're still working through what was done in response to the COVID shutdowns, let alone the rate hikes. I don't know where you want to take this, Jesse. We could talk for hours on any one of these threads that we've just teased apart here. But the takeaway message here, since we don't know even what will be happening when this goes live, is I'm not promising a blow up or a simmer down. I do not know what will happen, but this is indicative of systemic risk. And whether it tamps down or not, there's much more systemic risk out there. And we do know the Bank of England, and even Powell himself has said, yeah, we're going to be tighter for longer. We got work to do, kicking people out of their jobs. But if there's systemic risk, everything, all chips are off the table. So, even they are admitting this can be the cause for a huge change in course. And it's not surprising to see safe haven assets respond in this kind of environment.
So I wanted to touch on something you wrote recently in your newsletter, something I recommend to all viewers, by the way. I subscribe to your free version. It's great. But you were talking about a potential recession up ahead. And you said you believe a recession is on the way that will be more visible in the US first, but ultimately more severe in Europe. Can you walk us through that and what you're seeing there?
Well, I should say that my view is that we're actually in a recession or a recessionary period. The 2 quarters of negative GDP in the US have been dismissed by the mainstream. But I think future historians will look back on that as the beginning of the Great Recession or Greater Recession or Depression or whatever it turns out to be. I think in the future, people will look back and say, yeah, that's really when it started as a result of the COVID lockdowns. Never mind, everything done since the GFC. So, but we've had all these wonderful positive reports. The labor market's so strong, the consumer's so strong. Well, I don't think we've had all these wonderful positive reports. I think we've had a masking effect. We had companies having such a hard time to hire during the lockdowns that they became very reluctant to let people go, even when they knew they needed to, until they had no choice. So we had circumstances of the broader market, the leading indicators, yield curve inversion, 27 other soldiers in the firing squad all had their rifles pointed at the economy. And the one guy over there with his rifle up in the air is the labor market, which means consumers had money to spend, right? And everybody's saying, oh, everything's fine, because, this one thing means that we can't be in a recession. Well, you can be in a recession with low unemployment, especially in countries with a gulag where that's your alternative. It does happen. It is not synonymous. And in this case, I think the employment situation was masked by circumstances, and that mask is starting to come up. And remember, when you have these big layoffs that we've been seeing for months, and people are saying, well, you've had these layoffs and the employment rate's still high, so it's fine. No, it's not fine. It takes time from the announcement of layoff before the people actually get their pink slips. And then a lot of these layoffs, especially the high-paying tech jobs, they have severance pay. It takes time before that trickles through to show up in unemployment claims. And then it also turns out that they maybe weren't quite calculating them right. They changed the formula. And then suddenly, what had seemed like a stubbornly low jobless claim numbers, suddenly, the slope of the curve completely changed. Starting a couple of weeks ago, turns out, oh, sorry, actually claims have been going up. And the continuing claims have been really steadily going up. So So no, I think the recession is actually ongoing. I think it's going to be worse. And to your question, Europe has the so-called broader safety net, right? They have much more generous employment and unemployment benefits. It's harder to fire people over there. So on the downside, that shelters them. You'll see the trouble and unemployment delayed there because of these more generous benefits, if you want to think of them. Of course, it's generous at the expense of the taxpayer. The US doesn't have that so much. So I think the impact shows up here first. But also, we had the Fed led the way in tightening. It is now leading the way in easing up. So it also makes sense that we would see the impact here first. But for those same reasons, to the second part of your question, those things that delay the pain in Europe also make the pain last longer. It is more burdensome. It is a tax, literally and figuratively, on the economy to have these benefits. There's no such thing as a free lunch. You're going to give people lots of free stuff and great bennies. Well, that has to be paid for somewhere. And that comes out of the economy. It makes a recovery more difficult. How this translates, well, it impacts many things. But for us as resource investors, particularly for gold bugs out there and silver uber bugs out there, the relative hawkishness of central banks is driven by these variables, and that impacts foreign exchange, the dollar, exchange ratio on other markets, and monetary metals are alternatives to the dollar. So we've been seeing this very strongly over the last year, how gold in particular has almost abandoned interest rates as false signals and tracked the DXY directly intraday on a daily basis. So that has started coming unglued a little bit. I don't want to get too lost in the weeds here lately. I think things are starting to change, but the dollar is still clearly very powerful here. And so this whole thesis of the US leading the way on the way up, on the way down, is actually bearish dollar for the near term and bullish for alternatives, including gold and silver and the euro. But then once Europe catches up, we'll see how things go.
What's up, guys? Quick break. My name is Jay Martin. I'm the CEO of Cambridge House and the host of the Vancouver Resource Investment Conference. I wanted to quickly point your attention to a link right beneath this video where you can subscribe to our new weekly newsletter. If you want to better understand the minds of the best investors in the resource space, subscribe to this newsletter. I author it personally every Sunday, and I love writing it. Hit that link below to subscribe. All right, back to the interview.
You wrote a great article on Independent Speculator recently called Bad Math, A Brief History of Failed Economic Predictions, where you go through a big list of notable economists and other so-called experts who made bold predictions, all of which failed to come to pass. Now, I feel like with the advent of social media, this is getting more common as more and more people start to chime in with dire predictions. Of course, those always get the most clicks and engagement, so people are kind of incentivized to be hyperbolic. So as an investor, how can we shut out the noise and stick to the data? What's your strategy there?
Oh, well, there's so many ways to go there. But I have to say this. First and foremost, I didn't write it. I have a team now. I am the independent speculator, but I have a team that helps me. We cover more than 600 companies now, and I just can't do that on my own. That's too much even for me. So way too much. And that particular piece was written by Kyle Johnson, a resident meme master. If you see my funny memes on social media, he's the guy who comes up with most of those, sometimes with a little help from the old wolf, but he's just a really creative thinker who gets Austrian economics and our perspective and understands the investment thesis and our mining stocks and stuff. So just a great fit into the team. He came up with this, and I had written something under the very dry subject deliberately. So it was called Empiricism versus Rationalism in Securities Analysis, with a nod to Messrs. Graham and Dodd in the title. And it was making this point, right? You have this theory and it gets people all excited. Central banks are hoarding gold, or the BRICS countries are going to go with gold-backed currency, or, the Trilateral Commission is going to take over the world with CBDCs. All these big theories, they're wonderful for great headlines and, clickbait. You make these big predictions. People love that. But even if they're true, they take years to prove out, and then suddenly it turns out that history decides to take a different direction. It's funny, some of the ones you mentioned, we mentioned Paul Krugman's famous quote about the internet being a fad, and that it would end up the way of the fax machine because people would find out they really didn't have all that much interesting to say to one another. Well, so that kind of not quite predated the internet, but it was before social media, and still people were doing it. Everybody loves publicity if they can get it. Takeaways for investors are, you could read my piece for the theory, why it's so. You can read Kyle's piece for examples and some fun with it. But the takeaway is that it's our job as investors and speculators to be skeptical, and particularly skeptical when somebody has this great grand theory that explains everything and makes all these predictions. Somewhen after you've given us all your money, and and we'll see how it goes. There's so much I could say, but I'll leave it at that.
Yeah, and I feel like because the news cycle moves so quickly on Twitter, because people are tweeting every few hours, I think people feel like if they get their calls completely wrong, it doesn't even matter because people have forgotten about it and they're on to the next thing. So I feel like that's kind of become a bigger problem these days that people need to be aware of. So I wanted to get your thoughts on uranium here. We always discuss uranium when we chat. And you've mentioned that you're sitting on the sidelines when it comes to a number of commodities in anticipation of a potential drop in price up ahead due to a recession that you're seeing, except for uranium. You note quite frequently in your newsletter that you are on the lookout for uranium names that you haven't added yet, as you feel that the sector presents an attractive value proposition. So first of all, do you currently think uranium equities in general are priced at attractive valuations? And are there any new developments that have you bullish in the sector right now?
Yes, and several. So I think actually anybody who's watched you interview me before, Jesse, will remember that I'm not a jump up and down, smash the buy button kind of person. But I actually feel quite strongly about this right now. There is a uranium stock that is the top of my shopping list right now. But the stocks have been whacked with the broader market, maybe even more whacked than the broader market, even while uranium has been doing quite well. Not only has uranium had a good year, in the last couple of months, it's gone from 48 to 54. It dipped a bit yesterday. We'll see where it goes today. But that is a substantial move in a pretty short period of time. And at the same time, the stocks have gotten cheaper. Now, when value and price diverge, there is clearly opportunity. Either the price of uranium needs to go down, or the price of the stocks have to come up. Those two can't diverge forever. I think the price of the stocks will come up. So as a broad generalization, I think now is a terrific time for anybody that missed the uranium parade, right? And that it's actually been a sawtooth pattern up and down for the last 5 years. It went from 18 to the 50s over the last year or so, 40, 50. So if you missed all that, this is your chance. I'm not saying it's your only chance. I'm not saying it can't go down. I'm saying the stocks are objectively a much better buy compared to a commodity that is in a rising trend right now. And probabilistically, that is a buying opportunity. It isn't the only thing. I also like gold and silver for the nearest term. The caution that you mentioned is really because of the recession that we started talking about. Most minerals, industrial metals going into a recession get whacked, and they get whacked hard. And it doesn't matter if they're below cost of production or whatever. We've seen copper, for example, back in the late 90s, stay below cost of production for years. So when a market change happens, when the recession that I think is already underway, when the denial of that recession goes away, the knee-jerk response from traders around the world is to sell commodities, sell industrial minerals, sell the energy sector. And that's why I've been saying there's some of these that I like quite a bit. I'm actually quite bullish on oil. I've come around to to the lithium case, but for after the recession on that, right? The exception are gold and silver, obviously as monetary metals. They're different from pork bellies and copper even, or whatever. Their monetary metals are different. I expect silver to underperform gold in the nearest term because of its industrial side, which we all know and love and hate, but it's there. So but that doesn't mean I'm bearish. That just means I think it won't do quite as well as gold in the nearest term. I'm happy to buy a great gold or silver stock right now if I find one that makes the grade that I've missed. And then uranium is really the one that's exceptional because it's not a monetary metal. It's an energy mineral. And the energy sector typically does get whacked, but it's baseload power. And unlike almost everything else, it has been below cost of production. It's an industry that's been in liquidation for years. And the logic has been there. The fundamentals have been there for years. What's different now is that the narrative has finally come around. And with Europe, despite Germany kicking and screaming every step of the way, with Europe doing a really hard pivot towards nuclear energy, with the very pragmatically minded Eastern Europeans leading the charge, with not just one or two, but dozens of new plants now that they're considering in small modular reactors, and even the UK saying the SMRs are the wave of the future, and even the Biden administration not just saying that, oh, we need nuclear, putting money into it and supporting research for advanced nuclear with billions of dollars. I mean, this is a huge sea change that it's not just maybe someday or imminent or, this anytime now. This is happening now. And uranium prices are going up. It's not a promise that they have to keep going up, but we're speculators. We're looking at the odds. This looks really, really good to me. I sincerely think that it would take a Chernobyl style event to derail this thesis in the next year or two.
I wanted to hone in on gold for a moment as well, because you noted recently that gold has been inversely correlated with the 10-year Treasury, and a rally in the 10-year note price correlated with a significant retreat in gold. You said you're not unhappy to see that. Can you explain why, and how does today's price action for gold play into that picture?
Well, yeah, so it relates to what we were talking about before with gold and the DXY. That's actually an aberration. It's multivariate, it's complicated. If it was simple, right, it'd be no brainer. Everybody would know what to do, and there'd be no opportunity to profit because everybody would do the same thing, right? Every trade in the space would be crowded. Because of all that, it was multivariate. But the most powerful variable, the most explanatory variable in the gold dollar exchange ratio since Nixon freed that to trade in 1971 has been real interest rates. And since real interest rates don't update constantly, right, you get a monthly CPI print or so on, it's the 10-year benchmark as a proxy for real rates that on a short-term basis drives. And then on a longer-term basis, you look at year charts or multi-year charts, and it's real rates that for 50 plus years now have been the most explanatory variable in the gold dollar exchange ratio. Over the last year, really since Russia invaded Crimea, that was the last invasion, since Russia invaded Ukraine, that has taken the back seat, and it's been directly the dollar on foreign exchange, and specifically the DXY. I mean, you look at it not just on a daily or weekly or monthly basis, but intraday. The wiggles from minute to minute, some headline crosses that causes people to say, oh, bad for the dollar, pile into the euro. That's good for gold as well. And so that's been a very powerful explainer. As I was saying earlier, I think that's still in effect now. It's still going on. And this week we're seeing that happen with the price movements. But we're starting to see that start to come unglued. And the interest rates with the 10-year as a proxy for real rates in between, inflation prints and so on, that's starting to show more influence again. So I think that, I'm not sure that the Ukraine invasion actually had anything to do with it. It could be coincidence that that's when it started. But I think that with the massive intervention in inflation and rates, and the Fed, previously not responding to inflation with rates, I think a lot of traders kind of gave up on the rate. It wasn't giving them a real market signal. So they decided to use the DXY instead of the benchmark 10-year as a primary rate it is a rate to determine their trading decisions. This isn't you or me. This isn't gold bugs or miners. This is COMEX traders, LME traders. And this is a theory. I can't prove it. But my theory is that's why we saw the DXY take over the driver's controls last year. And I'm saying this is starting to change. And I'm saying this is good because for now, we've had the Fed lead on the way up. The Fed is leading on the way easing. That's bearish dollar, bullish for alternatives like gold. That's great. But at some point, you get to that destination. And at some point, Europe catches up. So you really don't want the DXY permanently to be in the driver's seat. If so, we end up with Brent Johnson's dollar milkshake, slurping up all our lunch here. So to see the real rate or the interest rates come back into play is, I think, really important. And particularly if I'm right about the recession and sticky inflation, it means that rates remain negative in real terms going forward, going into a recession. And that starts to look a lot like the 1970s. So I think we could actually see circumstances where the dollar and gold go up together, as we did in 2004, 2005, or during crunch times, like during invasions and things like that, where you see safe haven assets move as a group. And, for the time that the dollar is seen as a safer haven, I think it becomes, very good news for gold and silver investors or company investors and hodlers, that reality, that the economic turmoil brings the safe haven aspect into the fore instead of this Forex dynamic, which, as I say, I think has been an aberration in the market over the last year.
So in this recessionary environment, you're saying you think it'll become apparent in America first, then become strong in Europe as well. Is it time to maybe be looking at emerging markets, at international markets, places outside of North America and Europe, perhaps India and Brazil? Do you think, is there any countries, I guess my question is, there any countries that you see that are not going to suffer from these recessionary effects where there may be opportunity outside of one's own home country here in North America?
No. In particular, China, I think there's been this sort of hope, and there's this kind of muscle memory of China helping the world recover from the GFC. China just can't grow at the rate that it did those years ago to do that again. And, it still has its own knock-on effects from the COVID lockdowns. I think there was an open question, how much would the pent-up demand in China, which had a much longer lockdown than any other country, I think that was a reasonable argument that maybe China could help the global recession, counteract it. I think the evidence is now pretty clear. We're in May already, and there is a reopening, but the Chinese manufacturing is not booming. In fact, the latest numbers were of a retracement. And the reopening is manifesting itself more like in other countries, going out, traveling. It's been good for travel, but not so much for manufacturing, which hasn't been great for commodities. So that's just China. And then there's all the countries in that part of the world that depend on China. Everybody trades with the US and Europe to one degree or another. If India does better, it's going to be because it's buying cheap Russian oil, refining it and selling it to Europe, that sort of thing. So I won't say that there's no country that can do better. And particularly if, despite all this trouble, the West continues pushing the green agenda ahead, resource-dominant economies should do better than others. But I don't think there are any that are immune to a global economic recession. They're all going to get hurt. If China's number one customers are Europe and the US, and if they're in recession, that's going to hurt China. If Europe, the US, and China are all hurting, everybody else is going to hurt too. Nobody's going to be exempt. Which is why basically I'm not buying. Normally I'm not just a gold bug. I have a fairly diverse portfolio, but right now I'm not buying copper. I'm not buying lithium. I'm not buying anything except gold and silver, safe haven metals, and then uranium, because I do see it as different from every other energy or industrial metal or mineral.
Well, thank you so much for joining us today, Lobo. It's always fascinating having a discussion.
Even though I rained on the parade there. Sorry.
Yeah, on that sunny note.
People like emerging markets, but sorry, one more thing. I'll let you go. But what does it mean to be an emerging market? It means not a developed market. It means higher risk. If it's emerging, it's because there's still issues with rule of law and institutions that, when it's kind of like high yield for bonds. The emerging markets are the high yield of the equities world. And if you're going to go there seeking alpha or even beta, understand that you're taking on more risk. It's not like it's the same and it's just their turn now. They're cheaper, so they're going to go up. Well, if they do it, you're taking greater risk for that greater return. Sorry, I'm raining on the parade again. But it's my job to call them like I see them, Jesse. Hopefully the audience will appreciate that.
No, absolutely. That's why I always appreciate talking to you. And I have been hearing a lot of talk about emerging markets set to outperform. And now it's the time for the East to rise as the West is in terminal decline. It's a shifting of the landscape. Yeah, yeah. So it's great to get a more practical kind of level-headed look at things. So really appreciate you joining us today. For those who want to learn more about the Independent Speculator, could you fill us in on that?
Well, sure. I'll just quickly say for the 3 people who didn't stop listening that if you do sign up for the free weekly letter that Jesse mentioned, we will not spam you with a flood of daily advertisements. The letter itself, I try to provide as much value on these topics as I can and hope that will persuade people to consider our for-pay services. But we hope you won't regret it if you try it.
Yeah, I don't think people will. As I've mentioned several times, your newsletter is the only one that I always read when it hits my inbox. Always appreciate your insights. And thank you once again for joining us, Lobo.
Thank you, Jesse.